Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures page on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress on our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. Today, I just have a few macro updates with the latest University of Michigan data that just came out today. And then we'll be going to Tavi, as usual, our macro strategist. And he's going to be talking about the question that we get a lot about the junior mining stocks and what's going on with the lag. And like I've been saying, the lag is your friend. So Tavi's going to explain what we mean by that. Quentin is going to be talking today about silver, but also about open pit mining and some important things to pay attention there, especially with respect to grade. And I'm not going to spoil anything there. And then he'll have a few updates as well on some of our newsworthy items. But so what's going on here? The University of Michigan consumer confidence or consumer it's not, what do they call it? It's not the confidence, but one of them's the confidence, one's the consumer sentiment. The consumer sentiment index came out today. It was a huge miss, a huge disappointment. Actually, the biggest miss on record, which Zero Hedge noted today. And we're at levels of the Michigan consumer sentiment index that is typically what we see, right ahead of a recession. We saw this ahead of the COVID recession. We saw this, during the housing bubble, ahead of the global financial crisis. We've seen it at other times, like in the early 80s, double dip recession, and also, also in that 1990 recession in the wake of the savings and loan debacle. So this is important news, but what's one of the major things going on here? Please go on to the next. Is that inflation expectations just continue to rise. And so this was an interesting chart that I saw on Twitter from Tier 1 Alpha that is looking at one of the components of the Michigan survey that is looking at where expectations for inflation over the next 5 to 10 years are 10% or higher. So among survey participants, what's the percentage of those in the survey that think that inflation over the next 5 to 10 years will be running 10% or higher? And we're talking about levels where 15% of respondents believe that inflation can be running at 10% or higher over the next 5 to 10 years. And this is also comparing it to 5-year trailing CPI. So the 5-year average annual CPI over the last 5-year trailing time period, you can see in that blue line has been, the blue line is actually expectations at 10% higher. So the brown line is the 5-year trailing CPI, and you can see that 5-year trailing CPI is up over 4%, and it's just been on the rise. So the Fed has originally they told us that inflation was transitory, and more recent, and then they realized they were behind the curve. They started hiking rates. But they're saying, but don't worry, inflation expectations, we expect them to be coming down. There were 6 rate cuts priced into the curve, at the beginning of this year, 6 rate cuts. That's down to less than 2 rate cuts now expected. Why? Because inflation expectations are not coming down at all. They're continuing to rise. Let's go on to the next. And this is looking at the mean 5 to 10 year estimate. So at the mean among the Michigan survey participants, the next 5 to 10 year inflation estimate is now 5.2% or 5.3%. It's popped up. And a lot of people look at the median. That's the one that's featured on Bloomberg, and it was supposed to come in at 3%. It came in at 3.5%. But the mean is actually much more reflective of the diversity of opinion, like those people who think that inflation can be above 10%. There's a huge diversity of opinion about where inflation is headed. But at the mean, people expect it to be 5.3% over the next 5 to 10 years. So I don't know what the Fed is thinking, but we are so far away from this period like 2-3 years ago when the Fed told us that inflation was transitory. It's not been transitory at all. Inflation expectations just continue to rise. And they did that transitory thing basically all over again at the beginning of this year by signaling that they were getting ready to cut interest rates because they expected that inflation expectations would be coming down. Inflation expectations are not well anchored at all. This is a major, major problem. This is why gold and silver are breaking out, why commodities are breaking out. This is why the market overall is starting to stall out. I know it seems like the place to be invested is still the Magnificent Seven, and we are retesting the highs in the S&P 500. But you look at the sectors that are actually hitting new 52-week highs. It's the defensive stocks. It's utilities. It's consumer staples, and the broader stock market is really starting to weaken and stall out at the same time as you're seeing metals really start to perk up. You're seeing commodity stocks perk up. You're seeing large cap gold stocks perk up, and you're even starting to see small cap and even junior mining stocks perk up. I know the juniors are lagging. Tavi's going to be getting into that next, so let's pass it on to Tavi.
All right, there we go. Thanks, Kevin. Well, let's get started with the elephant in the room. I think it's a question we get the most, which is why are the junior miners lagging the other parts of the industry? Here's a chart that goes back a little, all the way back to about May 30th of 2023. That was a time, as you can see in this chart here, was a time when the TSX Venture actually broke down their index into subgroups of the precious metals industry, which allows us to sort of see here how has been the performance of this part of the industry, which majority of them are small cap companies. And you can see here that they have significantly lagged other parts of the industry, even the commodities themselves, gold, silver, and even the senior miners. And I think it begs an important question: why is this happening? So let's break it down and some of the reasons that we believe are causing this lag. Let's go to the next chart. So the first one is that this is normal. It's a normal phenomenon. I think Quinton had a slide in a few weeks ago in which he had how capital tends to flow into gold first, and then you see copper and silver and other precious metals that are linked to gold itself, and then base metals as well. And then you see the seniors, and then finally you see the money flowing into the smaller parts of the industry. As Kevin likes to say, the lag is your friend, and I would totally agree with this. I don't think what we're seeing is anything unique. It's something that we've seen in the past, and it's a matter of time, in our opinion, for the capital to finally flow and be attracted by a higher risk, but also higher potential for returns which is mostly in the junior mining space. I think the second thing that's been happening is investors have had many failed attempts trying to mark a bottom in the junior space. And I think understandably, they're very skeptical about this industry. We also know how some of those companies and majority of those companies have carried their capital allocation in a terrible way over the years, and also depleting cash for I would say a very misallocation, very large misallocation of assets overall, that I think cause as well some of those issues. But those are usually great opportunities to be looking for an activist role in this space. So let's go to the next slide. Is this time different? I think this chart is a great chart just because it shows the cyclicality. I don't think there's a lot of industries and I should say a lot of asset classes that shows this cyclicality so well illustrated in a chart like the commodities to equity ratio. No, I don't think this time is different, but investors tend to believe that would be the case. And history doesn't necessarily repeat itself, but it does rhyme. And I think we're in a moment right now that is very pivotal, in which a lot of investors are throwing in their towel and saying this industry is worthless, and I'm never going to deploy capital into the space. Unfortunately, we've had the news that Stransberry today actually was, I guess, announced that they're not going to be covering gold stocks anymore. All those things are starting to happen in the space, and I think people are still very skeptical about gold itself, although things have changed, at least in the last few months, with the purchases of central banks that have become more and more evident. However, the junior mining space continues to be very neglected and hated, which is, to me, a sign of opportunity. So no, I don't think this time is different at all. I think investors tend to think that what's happening today is unique relative to history, but we've seen something similar to what we're seeing today. And let's dive into why we think that that's the case. So let's go to the next chart. I think so far I haven't answered one of the main ththings, because yes, if they're lagging, because the lag is your friend, and that's common, and that's very normal phenomenon to see if you enter the beginning of a cycle, or the second option, in which I think that the first thing we need to understand is if we can check the box of being in a secular bull market for gold or not. So I'm going to offer a few bullet points that I think kind of fall into the category of why do we think with so much conviction that this is actually the case, and maybe why investors have been so skeptical about this industry are poised to be wrong-footed here in this space, and therefore why we've been allocating capital into this industry. Let's go to the next charts now, that we're going to dive into the reasons why we think we're in a gold secular bull market. Well, we've seen central banks buying gold recently. I've used this chart before. I don't want to overuse it, but I think the point is such a fundamental part of the thesis is the fact that we've seen central banks buying record amounts. But when you put that in historical context, we just haven't seen anything yet. Back in the 70s and 80s, I should say the early 80s and late 70s, as you can see in this chart, clearly central banks used to own about 75% of their assets in gold. And today we're below 20%. In fact, it's about 19% to be exact. And now if we go to historical average at 40%, that's a double from here. So that's one main part of it, is that this move is in early stages, in our opinion, because central banks are likely to be one of the main drivers of the price, and they have been recently, but they are just starting from our measurements of how much they own of the metal relative to history. Let's go to the next chart. Well, the other thing has to do with the second large pool of capital that we know. It's 60-40 portfolios, in which they also go to their own cycles. I mean, if you look at the cyclicality of the earnings yield of the 60-40 portfolio, so what does that mean? This is just looking at the valuation history of a 60-40 portfolio, basically given a 60% weight in equities, 40% in fixed income. In this case, we're using treasuries as the fixed income, and the S&P 500 as the 60% allocation in equity. And you can see from an earnings yield perspective, this is one of the most expensive portfolios we've seen in history of this portfolio itself. And prior times we've seen this, we've had big movements to the other side, meaning capital actually started to flow out of those two asset classes and into other things. And commodities and hard assets are likely to be the ones receiving those funds for many reasons. But that's the second reason why I think that we're entering a gold market, is because those traditional portfolios are yet to start buying the metal as well. Let's go to the third one. Here's another one, because those folks, they're usually, traditional portfolios usually managed by a portfolio manager, and those folks usually tend to prioritize volatility. And this is the first time in 45 years that gold has a lower volatility than treasuries. This is basically what this chart showing you. It's measuring the 7-year rolling downside volatility differential between gold and treasuries. And you can see this is the first time that treasuries actually are more volatile than gold. Every time it declines further relative to gold prices. And this is such an important chart, given the fact that as we see that happening more repetitively, which has been the case. I'm old enough to remember the days when people used to say gold can never rise with interest rate rising. And guess what? The opposite has happened. And I think that's precisely the case here, as people start to favor a new asset class as part of their defensive allocation. I think gold will play that role. Let's go to the fourth reason. Another reason has been the fact that we're entering a deglobalized environment. A deglobalized environment, not only from a perspective of logistics, from a fact that we're seeing reshoring and all those countries having to, not avoid relying in China and other authoritarian regimes, but also we're seeing a financialized, deglobalized environment starting to, or at least entering a phase of those. One of the main reasons why developed economies have been able to run such a long period of time of fiscal deficits is that they've been actually lending money to themselves, meaning, ECB will buy treasuries and then the BOJ would buy sovereign debt from Europe and so forth. So they've been financing themselves for so many decades. And now we're starting to see that with a deglobalized environment, and more tensions geopolitically, we're finally seeing the need for those countries to own a neutral asset. So to me, when I know that central banks used to own a lot more than what they own currently in their balance sheet assets, I can see the case for why we're just getting started in this potential trend. Let's go to the next chart. Here's an interesting chart that I saw that I would like to just supplement the same idea. We've seen a lot of Eastern societies buying gold, as I think other folks have been covering well. And one of the places has been China. And here's the trading volume of gold in China has spiked to levels we haven't seen in the past. And so you can see clearly, yes, maybe it is their central bank and others undisclosedly buying the metal, but also potentially even individuals that are looking to hedge their exposure to their own local currencies that are under threat of devaluing. Remember, I think I said this week. To me, the big short is really the debasement of fiat currencies over time. I think that's really the big short opportunity, in my opinion. Let's go to the next chart. And so another reason that it's been happening is, let's look at more on the micro side. Why do we think that we're entering a gold cycle? Well, if you think about from a supply perspective, I don't think we've ever seen such a constrained environment for gold supply. Arguably, this is one of the worst we've seen since the 1970s. Not only we know that there has been lack of discoveries, which I'm going to touch on that in a second, but also if you look at the existing reserves of gold, they've been also deteriorating in quality. In fact, if you look at the grades, the average grades of most of the gold miners have been in a secular downward trend. If we go to the next chart, what is interesting about this, McKinsey had a great state case not too long ago, in which they reported how much about 1/4, or was that 1/4? I think 1/4 of their gold reserves out there are actually refractory, which means they're going to be harder to mine. It's going to be more expensive. They're not the same quality of reserves that we've seen in the past. In fact, if you look at where we are today, majority of the gold in the world is in two places, Africa and North America. And Africa, as we all know, it's a jurisdiction that is not very easy to mine gold, given the risk, the political risk, and other issues. But the second thing is, if you look in North America, which is a place that has a lot of gold reserves, and you looked at the amount of those gold reserves that are actually refractory, it's almost 1/3, not 1/4. And so it is a large percentage of North America's gold reserves are refractory, which means it's going to be very costly to produce those, and therefore why we think the supply will continue to be constrained and probably provide a much stronger wave of in terms of the pressuring prices much higher. Let's go to the next slide. And you can see here as well, some people like to say production doesn't have a very good relationship with prices. I would argue against that because history shows us otherwise. As you can see in this chart, going all the way back to 1966, you can see that the white bars are basically looking at gold global production of the miners, and then the yellow line is basically, or I should say, global production in general. And then the yellow line is actually looking at the gold prices, and you can see clearly that in prior periods, that when we had a secular bull market for gold prices, also were marked by a decline of production. And if those existing reserves have a large percentage being refractory and other issues in terms of even the capital being so scarce in terms of the how to attract investors to invest in the space, it's obviously creating more supply constraints. And so certainly this is going to be another portion of that, and not to mention what's been happening with copper and other electrification metals that have been sort of changing the focus of most gold companies to start buying copper rather than gold. That's only going to exacerbate the gold trend, in my opinion. Let's go to another reason why I think this is a gold cycle. Well, we've been here investing in discoveries where we think there's going to be most of the opportunities here in this industry because of how much they have been neglected even within the industry. I mean, it's easy to find people nowadays, or not easy, but people that agree with the gold thesis will very much disagree with the thesis of investing in junior minings, which is quite interesting. But you can see clearly that a number of gold discoveries above 2 million ounces, we haven't seen many of those in the last 5 years or so. And at the same time, as you can see that those companies have been depleting their reserves. We call this a supply cliff of gold across most of the majors. And although this chart is a little bit old, I can guarantee you that nothing has changed really in terms of finding major discoveries to shift the supply curve in a significant way. And so this is very similar to what we saw back in the 70s. In fact, I think Quinton can provide more context on that. But certainly, at that time, even the valuation proposition of most of the miners were very out of balance from history, meaning the 1970s, the miners are also really depressing valuations. And I can only imagine, I wasn't alive at the time, but I can only imagine people also being extremely bearish, overly pessimistic about investing in the space, which usually, as I like to say, skepticism tends to morph into opportunity. Let's go to the next chart. As you can see here as well, from a CapEx perspective, is another reason why we think the gold market is entering a bull market. I've never seen a gold bull market start from CapEx cycles being at all-time highs. And today, particularly today, at a decline of about 70% from the peaks levels that we saw back in 2011, adjusted by GDP. And why do we adjust by GDP? Because inflation is a factor today, much more than even in 2011. We know that the economy has grown significantly, so it is only fair to be doing that. And in fact, if you just look in nominal terms, you also see probably a 30+% decline as well in this metric. But I do think this is a very useful way to understand how much capital constraints we're seeing in this industry, driven by lack of investors interested in the space, and also the difficulty to raise capital as well. And so this is a classic sign of us being as well in the early stages of a bull market, because it basically means that supply will be constrained for a long time. Let's go to the next chart. And then, if you look at M&A transactions, I've also never seen a bull market really start from crazy M&A cycles. Although here it's looking at 2007, we've had actually 17 transactions during that time that kind of carried on later on. On a dollar basis, which is even larger in 2011, 2010, we saw very large, very significant number of acquisitions happen during that time. Today, we're kind of starting to see some of those, but I think it will probably unleash one of the largest M&A cycles we've seen in history, and mostly given the fact that we have seen not only does the industry struggle with the quality of their assets, but also we've got segregated too much into too many junior miners. And I think we're going to see a consolidation in a large way that will drive the M&A cycle to levels we probably haven't seen in many years. And not to forget, there's something else going on here from even a government perspective. What we're seeing in terms of the infrastructure developments, is hard to believe we're going to go through all these bills that were being passed that are 3 times the size that we saw back in the post World War II environment when we're rebuilding the global economy. How in the world do we see all that money being spent in infrastructure without seeing the metals and mining industry consolidate itself, receive most of those funds, become more cash flow positive businesses, and so forth, and also become a higher weight of the overall economy? I think all those things are yet to come. Let's go to the next chart. And so inflation is another reason why I think gold is at its early stages at a bull market. We've shown this chart before, the 3 waves of inflation. Kevin touched on inflation expectations. That's what happens. It becomes a psychological impact in consumers and businesses. They start raising prices every time they have a problem. And you start seeing that over and over again. It becomes a domino effect. And so inflation tends to occur through waves, as 1970s, 1940s, and even 1910s shows us. And I believe strongly that we're at the beginning of a second wave for many reasons. And as we see that, usually what we learn about inflationary regimes is that investors start to buy hard assets. They start to favor more commodities. Therefore, why you see hard assets outperform things like financial assets during those periods. And so I think that's another main reason, is the early stages of an inflationary era will cause as well this bull market in gold to be in checking that box. Let's go to the next slide. And you can see here another issue is the reckless amount of fiscal spending. But even from a twin deficit environment, where you're looking at as well of how much current account or imports versus exports, if a country is importing more than exporting, and also on top of it is also spending more than receiving in taxes, that's what we call the twin deficit. Twin deficits tend to be very bearish for a currency. And we're seeing this across most developed economies today. I would believe that this is going to be another fundamental reason why hard assets are likely to outperform. And as I said before, the big short is the devaluation of most fiat currencies relative to things like gold, things like copper, silver, and so forth. And I think this is an important one. Today's levels of twin deficits to GDP are somewhere close to where we were at the depths of the global financial crisis, to put this into perspective. If you're a technical person, you're looking at this and it's making higher lows. Well, it's probably going to hit another low here as we see a recession unfold, or some sort of economic contraction. The next economic contraction will probably take this even further down as we see the deficits spending, exacerbate this metric in a large way. Let's go to the next chart. And so, many reasons why I think that we can say, and I'm saying this is my opinion, that I think we're going to enter a time when we're probably going to see stupid gold prices. When I say stupid, is because usually when I talk to people, they always want to know what's your target prices. I have no idea what a target price is for gold personally. I mean, I can try to design that looking at money supply. I can look at monetary base. I can see kind of relative to the S&P 500. I can see at prior cycles how much it tends to increase, and I can have an idea today. But I sort of think what we're experiencing today is sort of unique in the sense of I don't think we've ever seen a trifecta of macro imbalances, the inflation, the debt, and the valuation problem we're facing today. This is why I think a lot of people are going to flock into the metal over time, especially if we see things like yield curve control, a debt crisis, a complete loss of faith in treasuries and other sovereign debt instruments. All those things are sort of open to, I'm very open-minded to those things because I think that they could happen. Maybe the dollar becoming even more challenged as a reserve currency in the future. I think there's all sorts of things that could potentially create a real big movement in gold like we haven't seen since the 1970s. And as we see that occurring, it's hard to believe. It's really hard to believe that you can see the metal price rising like I said, to my opinion, in stupid levels, without causing the fundamentals of the businesses that mine gold to actually see those changing. Therefore, if you go to the next slide, you can kind of see one of my favorite sentences or quotes is "Bull markets make you money, bear markets make you rich," by Steve Hank. And it's a great quote. There's many quotes that sort of explain or express a similar idea of buying low and selling high, and having that conviction of accumulating an asset at such a depressed level when everybody disagrees with you. I love that sort of when I can find a thesis like this where I can put 15, 20, 30, 50 charts supporting my thesis, and at the same time most people disagree with me or us, and to me this is where the real opportunity lies ahead. And so looking at even juniors versus seniors as a way to sort of measure this neglection that we've seen in most of the small cap names in the industry, you can see clearly that we've been in a downward trend for so many years or decades. And now we're finally seeing a movement that kind of shows that perhaps we're starting to bottom in this. It's too early to say, but given everything I said here in the earlier slides, I really believe strongly that I would doubt that a gold market wouldn't be unleashing here in a secular bull market without causing this chart to break out, and other charts like the gold miners to gold or gold to silver and so forth. I mean, I can go on and on. I try to keep this relatively short of the reasons why we think that we're going to see a gold bull market. I could probably go on with more slides, but these are the main reasons why we think that this thesis is solid, and it's a long-term one that we want to take an activist approach and work so closely with a guy like Quinton. Let's go to the next slide. Now, silver is an interesting metal because now I've been of the belief that silver will outperform gold in this next gold cycle in a very significant way. And it surprises me that we have the gold to silver ratio still at 80, given how much gold has been moving already. Now, notice this difference between the movement we're seeing today versus, the prior movements we've had here in the last 5 years. If you recall, we had the COVID crash, which shows in this chart, and then we had a pandemic surge where a lot of hard assets actually surge in prices. And then we sort of declined from there at the later parts of the year. August was the very peak of that chart. And then again, we had another big movement that was called the silver squeeze, per se, was in, I believe, February of 2021. And then prices never came back to those levels. Those are sort of short-term spikes that we've had in silver prices. And today we're seeing, doesn't look like a short-term spike to me. It looks more like a sustainable movement to the upside. This is what I like about silver, is that no one is seeing this. I don't think a lot of people have realized that we're actually trading at those levels already of the silver squeeze that everyone was referring to, that we had such a level of speculation, short-term driven at that period. And today it's a much more sustainable movement. If you ask me where we're going from here, we're probably going to go back to the 50s and much higher, but that's just my opinion. And I think that the time to be accumulating assets that have leverage to silver were not only a year ago, but now, because we haven't really seen those movements on triple digits. You don't acquire assets at cheap levels, after the fact. You do that before those theses begin to unfold. And I do think this is going to be the case here. This is why it's my favorite metal when I try to at least pick one. But I do like all sorts of metals. And the prior presentation, I went through many different hard assets in gold prices, so you could see how most of the commodities are actually really cheap relative to gold, or meaning they're really cheap relative to inflation, if gold should be assumed as the real or true inflation rate that we should be measuring those things against. And so that's certainly the case. If we look at oil, we look at copper, zinc prices, all of those things are highly depressed historically, and which gives me the sense that if I believe in gold prices moving higher, then I think a lot of things need to be repriced much higher too. And that's the miners, that's junior miners, and that's other metals that tend to move along with gold as well. Let's go to the next chart. Now, interestingly, I've been pointing out the natural gas opportunity here recently. Again, it's another contrarian opinion, another thing that, I put out this chart and people, came after me and said, well, are you not seeing the supply glut that we have in the natural gas space and so forth. And that was certainly the case also when oil turned negative, where folks would come out and say, things that were, basically, I like to say a sentence sometimes, which is, tell me something new, something I don't know. And, the fact that there is a supply glut, well, that's already well known in the price, as you can see here. In fact, we're hitting a low in this commodity, although it has been rising recently. We're hitting a low in this that we've only seen in 7 other major bottoms. But you can see the main point of this chart is showing the future curve in the second, basically looking at a long dated contract versus a short dated contract, and you can see that we're seeing a very large contango in natural gas prices. Now, okay, keep that in mind. We're seeing a large contango. Prior contangos also marked a major bottom for natural gas prices. Guess what else is showing a contango? Let's go to the next chart. Silver prices are also showing a contango, not as cyclical as natural gas, because natural gas is just, if you think silver is volatile, let me welcome you to look at natural gas prices. It's like 50 times worse. But you can see here that this chart is such an important chart, also showing exactly the same thing. Future curve is in a massive contango today. We have the gold to silver ratio also at 80. We know that the supply remains very constrained for silver in places like Peru or even Mexico, which account for most of the production globally. We measured this as well here at Crescat, and it's really interesting to see how a lot of people continue to neglect the metal, and we're seeing a change here in this environment. The sustainable movement we're seeing in silver, to me, it really is aligned with the big story, which I think a lot of investors are ignoring as we see silver prices continue to confirm this breakout that we've seen recently. And I think we're going to go much higher. This is what gets me excited. Let's go to the next chart. Now let's talk a little bit about the economy, which is related to what I just said, and then we're going to go into Quentin. Here's a freight cost is an important thing. It's what causes inflation a lot of times is things like this. And we've had a first wave of freight costs globally actually happen, and then recently we started to see a second wave, mostly caused by the Red Sea. And there was a decline short term, and now we're starting to see another inflection higher. This is the Shanghai index, so it's mostly Chinese way of measuring the freight cost by containers. Now, let me point out that this index tends to lead global freight cost. And I do think that we're likely to see a reacceleration of this price that will also have global impact in terms of inflation. I think this is such a critical chart to be looking at. If I was a central bank, I would be. I know Fed had a few statements, or Jay Powell had a few statements last week saying, I don't see the stag, I don't see deflation. Well, here's deflation if you want to know. And let me show you the stag in a minute. Let's go to the next chart. I'll show you in a second, but look at the 2 versus 30s, basically the steepening of the yield curve. Another thing we've been talking about here, we're so close from a breakout in this chart. I think it could happen any moment as we pop from this, just like silver, just like gold. I think we're going to gain momentum. And remember, when you see the steepening of the yield curve unfolding, that usually is aligned with the recession as well. So I'm paying really close attention to this. This is maybe the stag for Jay Powell that I would be paying very close attention to. And not to mention, regardless of what happens with politics and so forth, to me, it sounds like both candidates are going to have to force the 2-year yields and the short-term yields lower at some point. In other words, instructing the Fed essentially to be cutting interest rates or having interest rates at a more affordable level. And at some point, we may see actually this inversion of the steepening of the yield curve inversion being caused by the fact that by suppressing short-term yields and letting the long end run because of inflation and the risk of inflation and supply glut and so forth of treasuries, we may actually see this steepening of the yield curve gain a lot of momentum. And so I'm paying close attention to this. This chart is looking better and better every day. And today it's not working very well. Yesterday, for 2 days, it worked really well. I think we're getting really close to something special in this chart. Let's go to the next one. Here's another one for the stag. So you can add to your folder, JPal, which is looking at the unemployment rate. This is such an important chart. And probably the takeaway from the prior week's labor data was the fact that labor markets or unemployment rates ticked up again. And look at this chart. Every single time this index crossed the 2-year moving average or the 24-month moving average, we actually had a recession or at least the beginning of a deterioration in labor markets. So, well, this is another one to be paying close attention to as part of this, the stag situation. Let's go to the next chart. I'm almost done. And you can see that about 2/3 of employment today comes from small cap companies. This is a chart I want to point out again. This is diluted earnings of large caps in white, small caps in red. And you can see the divergence between the two. Small caps fundamentally are not improving as the large cap companies. Therefore, you're seeing that those companies not making much money and starting to see a real contraction of their earnings likely will have an impact as well on labor markets. And so this just adds to that case of the prior chart. I think this is such an important aspect to be looking at as well. And, one of the main reasons why we've seen the small caps actually lag relative to large cap companies, and I'm talking more not mining companies, I'm talking about more broadly about the markets with the mega cap stocks versus the Russell 2000s and so forth. Although we're seeing a similar phenomenon in in the mining space, I'm referring to the broadly speaking about the market. Let's go to the next chart. And I think this might be my last chart, but this idea that I guess Druckenmiller was talking about, which I agree fully, which has to do with the stagflation. This is looking at the number of times that stagflation has been used in news stories on Bloomberg, and it's been starting to rise again. And it's claiming that we have a weak GDP and a hot inflation figure today. I would agree with that. I think stagflation is a highly likely scenario. Not to talk about politics, and I'm just paraphrasing what basically Druckenmiller said. Druckenmiller said, regardless of what candidate, we're probably going to see either stagflation or inflation. And I'm paraphrasing him again. I think we're going to see CPI rates of north of 6% perhaps in 2025 if Trump gets elected. And I think he talked about more of a stagflationary environment if Biden gets elected. I think it's a really interesting thought. And to me, I do think stagflation, regardless of who gets elected, and Crescat is not necessarily positioned for who is going to win elections in the next few months. But what we're really doing here is trying to understand the macro environment and what type of economy those candidates will be inheriting as we move forward, and most likely a very an inflationary environment that's very embedded in the system. As we see growth becoming harder and harder to be created, I think this is going to be the story of the next year or so. And as we see that happening, it's hard to believe hard assets and others will not take place in terms of being more favored by most of investors. So I hope I provided some sense in terms of why the junior miners are lagging, why I think it's so important to check the box of being in a secular bull market for gold, because that's the only reason why this time will not be different is if indeed we are in a bull market. Then I would say that most of those laggers are actually, Kevin, it will probably be right that the lag is your friend, because if it is a beginning of bull market, boy, a lot of things are very mispriced. With that, I'm going to pass it on to Quentin. And you're muted, Quentin. Sorry.
I put myself on mute because my bandwidth was reduced there. I don't know what was going on, but hopefully it won't glitch at this point. It's been a while since I talked about the paper silver seller here, but I've learned a lot in the past 18 months, really since we acquired San Cristobal. Silver market is a very interesting market, and a lot of it is driven by the fact that silver is a byproduct metal. Okay, and I'm going to try to show you some things I've learned. This is my view. I'll give that disclaimer first and foremost. This is simply my view of what is going on in the silver world. And it has a lot to do with people who wake up here in North America mainly. And every morning, I find it's a little before 6:30 a.m. here in Colorado time, which would be 8:30 in New York, but it would be, five little after 5 a.m. in Los Angeles, where our silver seller is. But I see the price get hit very frequently around that time of day. And I used to think, oh, this is, some grandiose scheme, shorting scheme. Actually, I think it's pretty simple how to explain this phenomenon now. Now that I can say I'm living it on the front line. Okay, go to the next slide. All right, so today, this is just looking at today, minute by minute, the silver price, and you can see right there. This is Eastern time, so this is New York time. You can see a little after 8, about 8:15, price, which was kind of trending around, 28.60, 28.70 all evening, all night long, is kind of holding tough there through Asia and even into Europe. But bam, got whacked right there. Went from 28.60 odd down to almost $28. In fact, I think it just touched $28 or so about 3 hours later. Now, look at the volume down at the bottom. That's a lot of volume. Okay. There's just a lot of people poking the button there to sell silver. And, I don't know how much that translates to in ounces. I'm not, don't have the capacity to dig that deep, but here's what I can say. Every morning, there's a lot of trading here in North America, and this includes silver, but it also includes other metals. And I think there's a dynamic going that might explain why we see this pattern in silver. Go to the next slide. And it has to do with the production of base metals. Okay. There are many, many copper mines around the world. There's many lead and zinc mines around the world. And silver, apart from a few silver only mines or silver predominant mines, we'll call it, is a byproduct of these base metals. All right. And every day, there are boats being loaded with concentrates. These are powders of concentrated metals that were produced at mine sites around the world. Okay, whether it's copper, lead, zinc, whatever. Okay, these concentrates are loaded onto boats. And usually at that point, not always, some people price it, at the mine site, some people price it at the smelter, but most of the time, the metal price of that material is set at the time the boat is loaded. Okay, interesting. Okay, so what does this mean? It means that basically, out of the 860 million ounces of silver produced, from mining every year, there's roughly 2.4 million ounces of silver contained in daily concentrates. Now, think about that for a bit. I mean, yes, there are some primary silver mines, and people will yell and scream at me, but whatever. It's close, call it 2 to 2.5 million, somewhere in that range of silver is contained in concentrates every day. Now, the companies, the mining companies that are producing those concentrates are worried about the primary metal, the primary revenue driver in those concentrates, the metal, whether it's copper, zinc, lead, whatever. That's their main focus. Okay. Silver is, they get paid for silver. Yes. As part of a contract, you will get paid for the silver content of your shipment, but you often don't put your emphasis on trying to price the silver. You're trying to price the zinc or lead or copper. Okay. And if you notice, copper and zinc and even lead to a degree have moved up very sharply in the past month or two. Okay. So what does this mean? Well, as the copper price moves, as the zinc price moves, the traders, the people that actually market the concentrates within the mining companies or on behalf of the mining companies, they watch those prices very closely and they try to lock in copper. Wow, 467, wham, they grab it. Okay. They don't necessarily look at the silver price at the same time and try to maximize the value. So it's really easy because the focus is on trying to maximize. Go to the next slide, by the way, Nathaniel. Because the focus is on trying to maximize the value of the base metal, the product in the concentrate. Oftentimes silver becomes the sacrificial ram in the situation. Okay, you go, okay, and geez, we have 300,000 ounces of silver in our copper cons. Oh shoot, we lost 30 cents today. Well, big deal. People just write it off because your focus is trying to get that primo price for your copper or your zinc. Okay, and I've noticed actually as we've taken charge of this mine and I've watched it on a daily basis. Oftentimes, when you see zinc or lead or copper moving up sharply, that's actually when silver goes through this daily phenomena of getting beat up, because they know that everybody's got their eye on those base metal prices, and they can try to kick silver a bit and try to basically short it on a short-term basis, because they know those traders, and look, they're very focused traders. I mean, these guys, there's only a handful of groups around the world that do this kind of trading. They know that there's about 2.5 million ounces available every day to cover their shorts. I mean, that's it, long and simple. Okay, so it's basically a self-fulfilling prophecy to see silver kind of kicked in the teeth every morning, or not every morning, but most mornings. Okay, all right, so this drives me nuts. I like silver. I like zinc too, but I don't. Well, zinc's my new fondest love. I've said that publicly, so I got to stick to that. Tavi's the silver guy, but I do like this. I don't like
this.
This
Is really interesting, Quentin. By the way, very very good stuff.
Okay, I don't like to see silver get kicked in the teeth every morning. Okay, it's very frustrating. Okay, so. Look, does Codelco view themselves as a silver company? No, but they produce a lot of silver. Okay, does pick your favorite base metal producer. There's a lot of big zinc companies. Like this Glencore. Well, I shouldn't say Glencore. They're so multi-commodity. That's not quite online. But let's say Teck. Okay, their zinc division. Do they see themselves as silver producers? Not really. Okay, they're focused on zinc. Okay, so silver, they can take a bit of a haircut, and the traders know it. Okay, and because of that, they might lose 2 or 3% every morning, or every other morning, or whatever, simply because they don't view themselves as silver guys. Right? There's not silver companies. Okay, so go to the next slide. So it drives me nuts. Though. Okay, so how can we break this cycle? I've been thinking about this for months now, because I see this pattern. It drives me bananas. I'm thinking, gee, Willikers, we could have, we had a boat ship like this month. We're just having one after another because we were backlogged there for a bit. So we've just had one boat after another. And I look at the silver price. Look, you can hedge, on a short-term basis. Like when was it? Early April, I think silver went up to 29 or something. And I did tell my team, grab some of those contracts. So we did sell some silver at 29, and they tend to layer the contracts. And I don't understand half of it because I'm a geologist, but we did manage to get those prices locked in. But we also have a lot of silver that we settle at market too. And you know what I'm thinking? I'm thinking if we really believe in our product and our commodity and our business, we should keep some of that silver out of the market. I mean, think about it. Even if St. Cristobal just said, "Bugger it, we're not selling our dang silver," okay, that would make people's heads explode. You would see these traders just lose it. Okay, and it's not just silver, but it's other commodities too. I mean, everything I'm telling you here, it could be applied to gold or other things as well. Just my view, but maybe if the miners got smart and didn't kind of have such exposure, the short exposure, they could make a little bit more money. All right. And it is something I'm giving some serious thought, because I got a board meeting next week, and I'm just as crazy as they get. So I'm tempted to tell everybody, let's keep our silver. That's our best investment. Keep our silver. Anyway, it's something to think about. Okay, so just my view. Again, it's my view. It's not necessarily 100% accurate, but it's what I see. All right, go to the next slide. Now, I after last week, I got some emails. Okay, I mean, we obviously we're big proponents of Snowline and some other stories out there, bulk tonnage stories. I think last week, what was it? It was Sitka that I talked about. They had some drill results, and everybody's like, "Oh, those are a bit deep," you know. Is that really going to work? And so I thought I would talk about a little bit, just kind of a high level about cost of mining, bulk mining. We'll say open pit, but also I'm going to talk about bulk mining underground as well. Okay, now I'm going to test Kevin and Tavi because I know I brought this up at some point in the past. I can't remember in what context, but if I was to take one of you guys and I was to put you inside that open pit, okay, where would you go? Where inside of that open pit would you go to find the highest grade rock?
Deepest part, lowest point.
Absolutely, absolutely. It makes sense, right? If they mined all of that rock above to get down to that rock right at the bottom, at the little point down there at the bottom, that must have a lot of dollar value in it, right? Because it takes a lot of dollars to move all that rock above it. Okay, so if you ever go to an open pit mine and you want to know where the highest grade rock is that's being mined, all you have to do is look down in the pit and go, oh, right over there. Okay, that's when I had a friend of mine who did his dissertation at Timmins, and he was doing it on the Dome open pit, which was active back in the 1990s. I used to tag along with them, and I'd look in the pit and I go, I want to go down to that bench down there. And then we go down, and sure enough, boy, you get in there and you look around, it's like buttered popcorn. There's little bits of gold all over the place. That's how you find the high grade. It's in the bottom. Okay, let's go to the next slide. Now, sorry. There's one thing. The cost of moving a ton of rock. This is just nuts and bolts. It's a pretty big range too, guys. It's about $1.50 to $4 per ton. It depends on your geography, some other factors. Moving a ton of rock and none of it, it's going to be about $4 a ton because it's hard to get your diesel up there and very expensive and so forth. Moving rock in, say, Bolivia, where we're at about $1.50 per ton. Okay, but that kind of gives you a range of how much money it costs to move 1 ton of rock, irrespective of whether it's ore or waste. Okay, so it basically just costs you that much to move a ton of rock. Let's go to the next slide. Okay, so what I did is I thought I'd just kind of throw a mental exercise at people to kind of illustrate some points about open pit mining. And what I've drawn here is, pretend that's an ore deposit. Okay, the grid is simply the block model for this deposit. So I've thrown a grid on there, and then we'll call the blue stuff, the light blue, we'll call that white is non-ore, non-economic material, but we'll call the light blue rock that you effectively are trading dollars. We'll call it trading dollar rock. Okay, so if you mine a ton of that, you'll probably get about as much money out of it as you put into it. So that's money. You're trading dollars on that rock. The white, you're losing money because it doesn't have any metal in it. You're not going to recover anything. So basically the white is waste. Blue, light blue, you're trading dollars. But the darker blue, that's where you're making money. Okay, that's your, quote, high grade. All right. I don't have grades assigned to these per se because I want to show you how different geographies and geometries and stuff impact a mine. Okay, so let's go to the next slide. Okay, so what I've done here is I said, okay, let's just erode this ore body. We're going to take it down so that flat line that goes across. Let's pretend this is somewhere in Canada where glaciers came across and they just scraped the thing clean. Okay, it's flat as a pancake at surface. Okay, now I've drawn a series of pits there, starting with a green one and then a yellow one and an orange and a red. Okay, well, why did I do this? Well, when you're building a mine, you take it down in stages. Okay, and so think of those as stages of a mining, of phases of mining. Okay, so the green triangle, the pit, is basically dive down into high grade. Okay, think snowline. Okay, think snowline. You know, that pit is in ore from day one. At snowline, I reckon that'll grade 2.5 grams, something like that, maybe even a bit higher. I don't know. It's wonderful stuff. You're making money all day long. Okay, but as you mine through that, then you start having to lay your pit back and start mining deeper. And notice you start taking in some of that light blue rock. That's a trading dollar rock. Okay, so you're not really making money on that, but you have to move it because you got to get that out of the way to get down to the blue, the darker blue. All right, it's okay. You're still making decent money, but you are, let's say the economics aren't as robust as they were inside the green shell. All right, fine. Let's go to the orange pit. Okay, so everything inside that orange. Now you got a lot of that trading dollar type rock you got to move, okay, to get down to those profitable blocks down there towards the bottom. Okay, so your economics are kind of starting to tail off, and this is typical of basically any mine out there. Okay, now this is what I would call an ideal ore body. Okay, because the thing sticks up and it's at the high grades at surface there. There's actually some deposits where the ore isn't at surface. In fact, the high grade might be deep, and you have to mine through a bunch of low grade trading dollar type rock to get to the high grade. Well, those are tough mines, and there's a lot of them. Okay, now why am I telling you all this stuff? Because as investors, I want you folks to get smart about what stories are going to be good mines and what stories aren't probably going to be so good mines. Okay, please just look at this and think about it logically. This mine, great money, starts to taper off. Sure, no problem. I mean, it's typical mine. Now, once you get out to the red, you're mining a bunch of waste there. At some point, the amount of waste you're mining overwhelms the economics such that you can't dive any deeper on this ore body. Okay, but it made money. It was a good mine. I will tell you right now, the inventory of mines that major mining companies have, by and far, are in the yellow to red range. Okay, there are bugger all mines out there that are in the green or above the yellow range. All right, there is a shortage right now on this planet of early stage mines that have great geometries and economics and stuff. Holy cow. Okay, this is a 5-alarm fire, because I don't care what mining company you point to. Most of their mines are long, long a tooth. They've already mined through the good, cheap, easy stuff, and now they're down into the hard yard type material. Think about that for a minute, okay? A deposit like Snowline, given the high grade at surface, that thing should be at an extreme premium, okay? To sell that thing for anything less than, well, I won't say it, but you get my point. It's a primo deposit, has this kind of geometry, will make a great mine for many years. Let's go to the next slide. Now let's look at a situation where you got topography working against you. You got this, high topography around your ore body, same ore body, but now instead of eroding down, it's flat. Oh man, this stinks. We're in a valley. We're in the bottom of a valley. Well, you can see there's a little green pit. Yeah, you can pull a pit there, no problem. Okay, but notice the next successive pits, the yellow, orange, and red one, you are struggling, okay, because from day one, you're having to strip waste rock, and look at the wings off to the side, the white. Okay, as you start mining down and down, your waste rock just overwhelms you. Okay, the amount of high grade ore or trading, high grade ore, we'll say, is diminishing, as a percentage of your overall material that you have to mine, and therefore your pits, are very constrained. Like you cannot dive into that ore body very easily. But the flip side is, go to the next slide. Some ore bodies are like this. Okay, they're basically positive relief. They're mountains, and the green pit here in this case basically from day one, you've got a lot of high grade ore, and even down into the yellow, you're still in really good ore for a long time. Orange, yeah, you're starting to get into a more trading dollar rock, but look at how far you can take that pit down. If you got positive relief like this, you can pull your pit down pretty dang deep. Okay. All right. These are the things I want people to start thinking about, because if you're investing in companies that have big deposits, bulk tonnage deposits, please start to understand the geometries of them and the impact that's going to have on the economics. I can tell you there's a lot of copper stories out there in particular, a lot of them, and I won't name names, but people can figure it out on their own, where the best copper is at the bottom. Okay. There's some up in British Columbia. Kevin and Tavi have had us sit and listen to me many, many times talking about these. When you got all your best ore at the bottom, good luck to you. Okay. Unless you plan to go underground. I'll talk about that in a minute. Okay. This is just meant to help people understand. This is just one aspect. I'm not, trying to overwhelm folks, but it's something to chew on. Okay. Go to the next slide now. Okay. Now we're going to talk about block caving, because somebody asked me, well, these results from Sitka, those are pretty deep. Rah, 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 rah. Okay, they are deep, and Mother Nature does what she does. She makes them deposit however she sees fit. All right. It is a reduced intrusion type deposit, no question. The geology is basically the same as snowline, but yeah, the higher grade portion of it is getting deeper. Now, do I worry about that? Well, yes and no. Okay. There are now on this planet many, many block cave mining operations. And human beings over the past, we'll call it maybe 30 years, 35, 40 years, say, have really become proficient at developing block cave mining. What are we doing here? Okay, we're going underground. We're developing, levels, tunnels and whatnot to access the ore, but also pull the material out as we mine it. Okay, so we're having to put in some development, tunnels and whatnot, but we're basically letting the rock mine itself. So we're opening up cavities that allow that rock to break down, and it actually uses gravity to fall into the chutes. We pull that ore out, and it can make for a fairly cheap form of mining. Okay, now you have to put a lot of money into development to get this thing going in the first place. But once you do, if you look at the costs, including development costs, for mining block cave, it's on the order of $15 to $30 a ton. Okay, again, geography can play a factor in that. Other things can play a factor. La la la. But this gives you a sense that this is actually fairly competitive, because on the open pit mining, when you get down deeper, you have to mine a lot of white or light blue blocks. In other words, you have to mine a lot of tons that add up. Say you're spending $2 a ton to mine, okay, and you've got a strip of 8 to 1. In other words, you have to mine 8 blocks to get the 1 block of ore. That's $18 a ton right there. Well, look at the cost here in block cave. It's about the same, guys. I mean, in real terms, block cave mining, same type of ore, the costs are not all that different. Okay, let's go to the next slide. So things like, I've discussed this with Scott Berdal actually in detail, because he has a lot of targets. Snowline has a bunch of targets scattered all over the place across the Yukon. And, Gracie is a great example. If you found something, a lot of people say, well, geez, they haven't hit anything shallow at Gracie yet. Does it mean there's nothing there? No, I think there's an intrusion there. There's definitely a reduced intrusion down there driving that thing. Okay, but the discussion then revolves around, well, could you mine it? And I would say yes. Okay, if you found a large volume, like 400 million tons of 1.5 gram rock at depth, you can mine it, no problem. Even gram rock. Okay, look at Cadia. Cadia in Australia, or East Cadia, I should say, the block cave there, I think runs 0.2% copper, maybe even a little less, I think 0.18, and something like 0.3 or 0.4 gram gold. I mean, we're talking about sub 1 gram gold equivalent type rock, okay? And it's in a block cave, all right? And it is very profitable. In fact, Newmont picked up Newcrest partly because of the proficiency they have in block cave operating. Okay, so things like Sitka, people worry all day long. Oh, Jesus, deep, da da da. No, I don't worry about that just yet. What I want them to do is find that. If they can find a big blue blob of 1-2 gram rock, somebody's going to figure out how to mine it, and I think they will. I think it's there. I think they're already demonstrating it's there. A few more holes, and I'm pretty sure we're going to see Sitka make that kind of discovery. Even Snowline, I think some of the new targets that Snowline has, I wouldn't be surprised if they start, drilling a bit deeper and trying to tag something like that. What I try to represent with the red line there is basically the volume that you would block cave in such a situation. Okay, all right. Makes a mine probably maybe even as profitable. You have different capex because you got to develop all that underground stuff before you can get in, but the nice thing about block cave is you're in high grade and will be pretty much through the entire mine life. That's the big upside there. Whereas, an open pit, you got to take what you have at surface first, right? So, but look, this is again just basic information that I hope helps some people understand things a little bit better. All right, let's go to the next slide. There are combinations of open pit and block cave mines on Earth, and this is a great diagram out of Freeport. It shows the Grasberg open pit, which was mined for many years, in fact, many decades now, over in New Guinea on the Indonesian side. But you can see they've migrated down to the large ore bodies that are deeper, that are subsurface, and they've been able to block cave those or sublevel cave those. Okay, so this shows you that you can have a combination of open pit and bulk underground mining in many scenarios. Okay, and that's another thing to think about. All right, go to the next slide. I think I have one more there or two more. Okay, so this shows you what a block cave looks like after it's done, or sometime after the. So as you mine rock out from underneath the ground, the hole starts to stope its way. It basically caves upwards, okay, and it reaches surface, okay, and the surface starts to subside. It forms a crater. It's not caused by something slamming into the ground like a meteorite. It's caused by something coming up from below, basically a void working its way up. Think of it more like a sinkhole. Okay, now a lot of people say, "Oh my gosh, that's terrifying." But if you plan these right, and you can, we're very good at geotechnics at this point. You can actually design your mine so that the surface is actually usable after you're done. Okay, so it actually makes block cave mining somewhat appealing. You don't have a bunch of waste piles and from strip rock and stuff like this. You don't have a giant open pit left. Okay, well, what can you do with a block cave after you're done? I'll go to the next slide. If you plan it right, you can make it into a lake. You can make it into something usable. Okay, it is truly, it is something. And I know environmentalists are going to, yell and scream and whatever. But if I worked at Newcrest back when they started working on the block cave projects, and I remember the discussions about the benefits of block cave mining and the post-mine use of land. Okay, this is important because you have a much smaller footprint here. You're preserving land use, other uses like farming or whatever. Okay, in doing so, this is important. All right, I don't remember which mine this is, but that Newcrest has done a really good job. I know they've done a really good job of planning how the mine is going to affect the surface and making sure that the land is usable after it's done mining. All right. That's an important aspect too. Okay. All right. That's my sermon on mining for today. Let's go to the next slide. A couple of updates. This is actually not in regards to something we're invested in, but it goes back to the few days ago, I think it was 2 or 3 weeks ago, when I talked about copper and the importance of copper in the mining space at this stage. Okay, you're seeing some gold companies migrate into the copper space. You're seeing, a lot of the multi-commodity companies like BHP, even though their focus is iron ore, boy, they're waking up and they're focused now on copper. And here you can see BHP has struck a deal with Ivanhoe Electric, and it's a little bit vague, the explanation of exactly what they're doing, but they are forming an alliance here in North America to look, in fact, the U.S., to look at certain projects in the Southwest U.S. Now that's interesting because it takes a long time to permit a mine in the U.S. So for BHP to stick their neck out here and go, you know what, we want to hunt for copper deposits in the U.S., I find that encouraging. Okay, it's good to see somebody stump up some money. Ivanhoe's already been doing it, but the point is we're starting to see some of the big companies stick their toe in and reinvigorate exploration for copper in first world jurisdictions. Okay, they're going to put in $15 million over a 3-year period. It's not that much money, but they're going to put it towards, it sounds like 6 different projects. Okay, and if I read this right, the idea is they're going to put up this money. Friedland and his team are going to go out and they're going to use their Typhoon system, which is basically a supercharged IP system. Think of it like it's great. Like, if you're standing on the surface, or you don't want anybody standing on the surface, you can't have cows or anybody else. Like, they put a lot of electricity into the ground. It's enough to absolutely raise your hair, so to speak. Think of it as lightning bolts inside the ground. So they pump a big whack of electricity in the ground and watch how that electricity interacts with the rock and so forth. It doesn't affect the ground or anything after it's done, but it certainly can light up, things like pyrite, other forms of alteration associated with ore deposits. Okay, but it's like a supercharged IP. Think of it that way. Anyway, I guess the idea here is they're going to test out 6 areas with this and try to find targets. They're going to try to identify drill targets. And then it sounds like they're going to form a joint venture, basically a 50-50 joint venture, in which they both contribute money to follow up on those targets with drilling. All right. That's the takeaway here. I think it's wonderful to see BHP step up. I really think there's a lot of copper to be found in the U.S. and elsewhere, Canada and South America, and many other countries. But it's nice to see this dedication towards the copper space. All right, go to the next slide. Okay, this is a company I've talked about many moons ago, Onyx Gold. When they first spun out from High Gold, they focused on some properties in the Yukon, but they also had some assets in Eastern Canada, in Ontario mainly. They drilled a few holes. They came in here, it was towards the late part of the season last year, and they tried to drill some holes very quickly at King Tut. They had some interesting results, but they weren't home runs. Okay, but then they went off and they drilled over in Ontario. And I love Ontario, I love Timmins, but I'm just not as big a fan of those properties as I am of these rig type systems in the Yukon. But it was a delight to see Onyx announce today that they have acquired a pretty strategic, or a few days ago, I think it was 2 or 3 days ago, a pretty strategic block of ground that forms the core of one of their properties. So let's go to the next. It's this WEAS property. Okay. Now you can see the kind of reddish, dark reddish polygon that outlines their land holdings over Main Tut and Golden Mass. This is where they did most of their work last year. But this WEAS project, it's about 6 square kilometers, sits right in the middle. It's right over the intrusion, in fact, inside of the King Tut block. Okay. Well, turns out that belongs to Snowline. Okay. And the companies have clearly been talking for a while, and they reached agreement. And Snowline's going to take a big whack of shares. I think in total they get around 3 million shares. In exchange, our friends here in Onyx can option in on this thing, and they can get in and explore it. Okay. Now this consolidates the target. I think that's a good move. I don't necessarily like to see a company give up anything, but in this case, I think for both companies' benefits, given that Snowline will get the upside of having a big shareholding in Onyx, I think it's a good move. Okay, it's certainly a good move on Onyx part. Okay, you can see here a presentation of all of their data to date. They got rock samples, soil samples, and silt samples, and there are very profound gold anomalies associated with the reduced intrusions here at Golden Mask and this main Tut area. And now they're consolidated. Again, now let's go to the next slide and look at an outcrop. Okay, this is a photograph from that block. Okay, and you can see the sheeted veins here. That is impressive. The WEAS block is actually a pretty high elevation block. Okay, so I know that there was a bit of head scratching about whether it's too steep to work or too elevated to work. I think it can be. I remember flying around here and looking at it, but the target is to die for. the sheeted veining in here looks pretty good, and it's not just here, but it goes over onto the adjoining ground as well. That's why the gold anomaly is where it is. Okay, now there was historic drilling here. This is going back, I think, to the 1990s that hit, a few tens of meters of 1 gram. But we also have a few surface samples. I think the highest grade surface sample is 20 gram per ton off of this material. Okay, so we know these sheeted veins are auriferous. This looks like a very, very well-defined target, a very easy to see target. I wouldn't be surprised if Onyx makes a discovery here this year. I certainly hope so. Okay, this would be delightful. Let's go to the next slide. Lion One announced some results this week from Morale. They have drifted over. Morale is a series of veins or lodes that are kind of west of that area that they've been developing so far, but they put a drive over a drift over into the Morale area, and they started doing drilling, infill drilling mainly, to start to define these lodes better and in preparation for mining. And it turns out those Morale lodes are just absolutely dripping with gold. Very solid results here. You can see the headline there. It's 64.46 grams over 8.1 meter. But you also have, 4.8 meters, 30 grams. So basically 4.8 meters of an ounce, as well as 8 meters of 2 ounce. I mean, these are crazy numbers. And these are very much in line with numbers you'd see out of the Emperor mine, say back in the early days. Emperor is a nearby mine very similar to Tuvatu that produced 7.something million, I think 7.6 million ounces of gold at this point. Okay, these are really good results. They now have access to these lodes, and these will become part of the mine plan. Very, very nice to see. Companies making good progress. I like to see this, but we do need to see the results and the expansion to that 500 ton per day goal that the company has. So let's go to the next slide. This is showing the sheeted lodes, and you can see some of the high grades they hit in some of these infill holes. The sheeted lodes mean they don't have to put in a lot of development. They can cross-cut this and then mine multiple stopes in a very small area. I think that's a big plus as well. Let's go to the next slide. Now, I-80 is kind of back in the saddle, I'm going to say. I did talk to Ewan, I think it was this week. I can't remember. Everything's a blur anymore. But I talked about to Ewan in particular about this Granite Creek zone. Granite Creek is one of several projects the company has. They have some of the highest quality gold assets in Nevada, in northern Nevada. Granite Creek happens to be part of the Getchell area, the Getchell Trend. And here you can see the plan view. Turquoise Ridge and Summer Camp, and then way up in the northeast corner there, Twin Creeks, are all part of Nevada Gold Mines operation there. They've got a big mine, underground and open pit there. So it's Newmont and Barrick in joint venture. Barrick's the operator and majority owner. Okay, but Ewan and his crew have this block of ground at Granite Creek towards the south end. And I think there's a lot of potential here. And I say that because I do know Barrick's drilling like mad, kind of right in the middle of that map there around the Summer Camp area. And they're finding ore like you wouldn't believe in the subsurface. It's mostly underground type material. But I think a lot of that carries down towards Granite Creek. Let's go to the next slide and I'll show you what I mean. Okay, so this is a cross-sectional image. I don't know why it's so fuzzy. Don't know what happened there. Sorry. But you can see that there's a profile about 600 meters wide here, where some of the drilling that's reached out and even been drilled from surface shows there's high-grade gold beds extending out well past the traditional mine area around the old what's it called, Marigold, or not Marigold, name fled in my head, the small mine that's up there in the north, in the upper left corner. There's a lot of blue sky there. Like, in my view, with the drilling they're doing and seeing these big results, 28 grams over 16 meters, 31 over 22 meters, 37 over 7, you got 31 over 2 and 15 over 7. These are really stout results. As they do infill into that area, they are seeing something come together, and it looks a lot like what Barrick's seeing just a short ways to the north. I think this is part of that system, and I think this will end up being a multi-million ounce discovery. All right, let's go to the next slide. Nice to see him back to work. Okay, last on the dock. Red Pine. Okay, for the past 2 or 3 weeks, I've had to talk about the situation at Red Pine, and this morning they came out with further information about what's going on there. And it has a lot to do with assays that were reported over the past 10 years or so. So assays released between the years, I think 2014 and 2023, or up until recent times. Okay, you can see here a summary of their findings to date. Okay, the correct assay results were sent via email by ACT Labs to the company, addressed only to the former CEO. In other words, the chain of command, what that means is the chain of command here, ACT Labs they would assay the rock, and then they would send the results directly to the CEO. Is that typical of most junior mining companies? Actually, no. Most of the time, junior miners have people inside the company, whether it's the vice president of exploration or a database manager or somebody, take in that data. They then, look it over to make sure the QA/QC checks out, et cetera, and then they feed it up to the chain to the bosses, whether it's CEO or otherwise, to work with them to interpret it and then put out a news release. It is a little weird that just the CEO was getting the data here. You got to say that was a surprise. Okay. It also asserts that the drill core assay results from the spring of 2015, there it is, to 2024, appeared to have been manipulated. It was manipulated drill core assay results. And this is where, it impacts things. It impacts their recent technical report. I think it came out last year. And some other works, obviously their news releases are impacted. But here's where my head explodes. Okay, the last bullet says 532 of approximately 98,000 drill core assay results in the overall database appear to have been manipulated. Okay, when they say manipulated, that's very, very clear. They interpret that the former CEO manipulated the data since Red Pine acquired the Wawa Gold Project in 2014. I think it was held by a private group before then. Do not forget, this is where I can't, it's incongruent, okay? Because you have a project that has a lot of historic drilling by many different parties. And quite frankly, it appears to be reputable. They're not arguing against historic drill results. But now, enter Red Pine, and we have this issue developed. And it's specific to 532 samples. Now, I would think if you're going to go out of your way to manipulate something, why would you only stick to 532? It doesn't make any sense. It's a little weird. Is it the highest grade samples? Well, I decided to do a little digging. Okay, so I went in. There's a little link there you can click on. Let's go to the next slide, and I'm going to show you what I mean. Okay, this is where I don't understand the why somebody would do this. Okay, you can see 2 gray columns. Okay, we're just going to focus on those. Those are capped assays. On the first gray column, those are the ones that were reported over the past 10 years. Okay, they're reported in news releases in the database. That was put into the 43-101, etc. Okay, over here, the second gray column is a corrected assay. In other words, the new management of Red Pine has gone back. They've looked at the assay spreadsheets and they said, these are the numbers that should be there. Okay. Now, here's where I don't understand things. I mean, yes, okay, you can see the first hole there. What is it? 1526. Most of the numbers shift down, shift down, shift down, shift down, shift down on individual assays. Almost all of those shift down. Okay, but then go to hole 31. Those are the same numbers. So okay, why would you if you're going to manipulate something, why wouldn't you manipulate the whole shebang or something consistent? That doesn't make sense. So like the first and the second are exactly the same. Third one in hole 31, yeah, that's a drop. Fourth one is a drop. Fifth one is a drop. Okay, all right. But why wouldn't you change the whole thing? Like, what would be the thought process to change like one or two and not the whole shebang? If you're going to go to that trouble or be that chonky, it just seems a little weird. Go to the next slide. Okay, this is just another example. You can see, let's see, hole 45, 1645. Yeah, there's a big drop. You go from 44 down to 6. But then the next one is pegged at 80. Basically, I don't know why it's a star. Maybe that was an over limit or something. Okay, but why wouldn't you change the whole shebang? Even down the row there, you've got some down in, what is it, 86, where you're just off by a few grams. Okay, like, I don't know. This seems very strange, guys. Okay, so back out of there, Nathaniel. I want to talk about this. Look, a lot of times when a company, and I don't have the data, I haven't looked at it, I don't know, but a lot of times when a company assays rock, and there's clearly a nugget effect in the sample, they will assay it multiple times, so you end up with duplicate assays. And just my hunch is this smells like somebody cherry picking. Like, let's say a rock was assayed 5 times, okay, and let's say it was like 0.3 gram and 1 gram and 3 gram and 28 gram. Well, it smells like somebody picking the 28 gram as the winner. That's just my gut. That's when I see this, it's so inconsistent how the data has been manipulated, but it seems to apply to, so my hunch is, yeah, it's manipulated, whether it was, with the intent of defrauding. I don't know. It's going to be a tough one. Other people will have to make that decision. But I'm just saying it's weird that somebody would just change, 500 and whatever samples and not the whole shebang. There's been other cases where, a company, or a person at a company changed all the data. Why wouldn't you do that? I don't know. It seems a little weird, guys. But that's about all I know for now. So don't have much more to say. That's it.
All right. Thanks, Quentin. So Red Pine still a little bit mysterious, and hopefully the new CEO can get that all cleaned up. Yeah. Glad that he's there. All right. So if you're interested in learning more about what Tavi was talking about, which is how to take advantage of this lag in the junior mining stocks as gold, silver are starting to break out and other metals, and the seniors are taking the lead. The juniors tend to lag. That's normal, but they also tend to go up a lot more than the seniors as the cycle gets going, and that's why the lag is your friend, because you still have time to get in while we have all these great signals. The timing signals, in our opinion, are just screaming, and there's still time. So a lot of people will say the train is leaving the station. Well, the train is leaving the station pretty slow for the juniors, but that's a good thing, and it's okay. So anyway, Tavi.
Well, not much to say here. I think I've already talked everybody else ears off. So it was good presentation from Quentin as well, and yours too. But I think we'll be back next week with more. If you're interested in learning more about Crescat, I suggest you to talk to Merrick. Here's information right in front of you. As you can tell, we do a lot of work and we go really deep into the things we believe in, and the reason why we've been working so closely with Quentin. So I hope you enjoyed this presentation. I hope it was enlightened to you in some way, but also as an action as well to at some point, in our view, take advantage of some of these opportunities that are presented in markets right now. But thanks everybody for watching. We will be back next week. Thank you.